Hello Sector Watchers, welcome to the show. This is the 172nd episode of Sector Spotlight for Tuesday the 18th of April, and I'm recording it on Monday the 17th after the close of the US markets. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. This week is all about the sector rotation model. It's about 3 months ago that we spoke about it last, and it's time for a review. So that's what we're going to do. And we're going to start with that. So I will not run into or run out of time at the end of the show, which sometimes happens. So we're going to start with a look at the sector rotation model, try to align it with the relative rotation graph and the macroeconomic indicators, and see if we can find an alignment. By the way, next week Sector Spotlight will be a rerun or an evergreen because I'll be traveling. I'll be visiting the CMTA symposium in New York next week, Wednesday through Friday, where I also will be speaking, obviously on RRG. But that means that I am traveling on that Monday, so I can't do the show, I can't record the show for you. The week after that, I'll be in the StockCharts headquarters in Redmond, and we'll do Sector Spotlight. We'll record Sector Spotlight in the studio there. So I'm really excited to use all the new glittery gimmicks and see what we can do. We'll see for kind of nice things we can do over there. But right now, ladies and gentlemen, this is Sector Spotlight. The last time we looked at the sector rotation model here in Sector Spotlight was on the 17th of January. So that's pretty much exactly 3 months ago. Time for a review, I would say. So on the left-hand side, I brought up the sector rotation model. You can find that on the StockCharts website if you go to the perf charts and then scroll down, and you'll see. So this is what you get when you see the perf charts, and then the sector rotation model page is right below that. And as you know, what we're going to do is see if we can make an assessment of the macroeconomic indicators as well as the rotation of the various sectors, and then dissect that, distill that into an opinion, an outlook for where potentially the S&P is in the cycle. So let's start with the 4 macroeconomic indicators. And the first one is the consumer expectations. And I've got that chart here on the right. Now this is not an exact science, so we've got to make an interpretation of what this chart tells us. And the four possibilities as given by the model I have listed right here, and we're going to pick one for each of those 4. And if I look at this chart and I got to choose, then I think that because we had such a hard decline here, we are in the phase of reviving. Maybe we're rising, but there is a very good chance that you get a little dip and then move higher. So it's definitely a revival, potentially rising. So that puts it in the model, full recession, early recovery. I am sort of biased towards the reviving area, so in a full recession, maybe moving to an early recovery. So that puts, as I said, consumer expectations somewhere here, reviving and rising. We're a little bit more towards reviving, I would say. Now the next of these macroeconomic indicators is the industrial production. And here we need to choose from bottoming out, rising, flat, or falling. And here I am pretty confident that we're flat. I mean, we're right at the level where we peaked in 2007, and again in 2014, and again in 2018, and a couple of months ago. So I'm going to say this is flat. which means that it's full recovery, and whatever the next step is, it looks like more, if you go through the cycle, it's going to be early recession and then full recession. But for now, I'm going to go with flat. So that puts industrial production in flat, which aligns with a full recovery on the sector rotation model for this indicator. The next one that we're going to look at is interest rates. And here, if you look at the possibilities and the various phases, it was rising rapidly for sure, but for the last couple of months we're moving kind of sideways. So whether that is peaking or still rising, I'm not sure, but it's definitely not falling, and it's definitely not bottoming out. Unless you want to see this as a bottoming out, but I think that's a little bit too long. It's a long-term model, but this is a period of almost 10 years. That's too long for bottoming out. So I'm going to position this somewhere between full recovery and early recession, which makes it full recovery and early recession. That's somewhere like here, a little bit similar as the consumer expectations. So the industrial production with flat is like there. So we're like coming in like here. Let's see what happens when we look at the yield curve. And the yield curve is right here. And there is no doubt about it. That is still inverted. So not even flattening out, it's inverted, not even flat. So that is definitely in an early recession. That puts the yield curve flat inverted right here. And if we look at that, then we got consumer expectations, full recession, early recovery. We've got industrial production flat. We've got interest rates, full recession, early recovery. And we've got the yield curve inverted. Now, one thing is for sure, well, nothing is for sure in this world, but I think that the biggest odds here are, and we've seen a few attempts over the last few weeks, that the yield curve will go back to being flat. So that means that we're going to see some sort of steepening for the curve to get back to flat. And if that happens, then we're going to see a move to normal. So, back to the start of the row, putting the yield curve into normal. So I'm going to put this like flat inverted, moving to normal, which means that the weight of the evidence is more towards the left-hand side of the cycle. So full recession, early recovery, with industrial production being the outlier with a flat reading. Now let's see what we can see if we're going to put the readings for the various sectors across the top of this diagram. And in order to do that, I'm going to use the RRG, the relative rotation graph, on the monthly time frame. So that's looking at really long-term rotations, but the sector rotation model is looking at really long-term phases, really long-term trends. So that sort of aligns with each other. Let's work our way from the left to the right. So start with technology. I'm going to rank them here by symbol so I can easily find them. So here is technology. That is definitely on the way back up after a rotation through lagging. Now mind you, when I look at monthly RRGs, because they're kind of slow, and looking at long-term stuff, you want to pick it up in an early phase. And this is already picking up relative momentum for 3-4 months, and it started to move to the right. So my reading on this is that it's neutral to positive. So for technology, I'm going to put in a neutral to positive reading. So, if you got to put a gun to my head, I'm going to say it's positive. It's a green. Maybe blue for neutral. If we're going to consumer discretionary, and that is still inside lagging, but it's got the same type of rotation. It's picking up relative momentum. It's starting to very slowly pick up relative strength. So that's kind of the same as technology, neutral to positive. And then when we go to communication services, it's inside lagging, but you see how long that tail is. It's definitely starting to pick up. If you look at the price chart, then XLC looks to be, completing or close to completing a massive bottoming formation. So that's definitely on the way up and picking up momentum here. And if you remember previous versions of Sector Spotlight where we look at the weekly RRGs, and then you know that XLC and XLK were actually inside the leading quadrant for quite some time. So they have been dragging the market back up. So XLC is definitely also in the neutral to positive area when I read it on the monthly chart. We go to industrials, then that is inside the leading quadrant. It's at a very short tail, which means that it is a stable relative uptrend. And that makes sense. So we got industrials here as an outperformer, completely in line with the RRG here. The next one is materials. So materials is inside the weakening quadrant, but as you can see, very close to the benchmark, inside weakening after a short stint through leading. So that means it's actually in a very stable relative uptrend. So materials actually is greenish, green. I'd say it's a positive. If we go to energy, and energy is right here, that is way on top of there. That's way to the right. So that's definitely a positive sector, but it's been rolling over. And the big question with this type of rotations obviously is this still a very strong trend? Or is this a strong trend that has ended and that is rolling over? And it's very hard to make that call right now. If you look at the weekly chart, energy is inside the lagging quadrant, but that's not a surprise after such a long tail on the monthly that is moving negative. I'm gonna rate this as neutral to positive. Neutral because there is a risk of it's rolling over. So I'm gonna rate energy as neutral. And then we have consumer staples. And consumer staples, so mind you again, long-term trends. So where we had the ones in red that were moving up, labeling them as neutral to positive, I'm gonna do the opposite for market like staples, because that is neutral to negative because it has rolled over, and that trend is definitely ongoing. So this has been losing relative momentum for the last 4 or 5 months. So this is a neutral to, let's say, negative. And if we go to healthcare, then you see a similar story. That's in line with staples. So you see healthcare rolling over. So again, healthcare also, just like staples, neutral to negative. And then utilities is in the same ballpark. So you got that also. You see how long that tail is, how rapidly it's been losing relative momentum and starting to move slightly to the left, which means losing relative strength. So staples, healthcare, utilities, they're all, let's say, negative, neutral, maybe negative. So from left to right, you see how it's getting from quite positive to quite negative. And we're going to finish it up with financials and real estate. So here is financials. And you can see that they're inside the weakening quadrant and they are now approaching the lagging quadrant, still close to the benchmark, but that's on a negative note. And that definitely goes for real estate. That's for sure a negative one. It's actually the weakest sector in this universe if you take it from the monthly readings. So with that, we've got the sectors that are right here, so technology, discretionary, communication services, industrial materials, they're all, either good or moving to good. And we've got more clearly a weaker rotation for staples, healthcare, utilities, and definitely for real estate and financials. So when I combine that with the reading in the table here, which is tilted to the left-hand side, to the full recession, early recovery. So from the macroeconomic perspective, we're somewhere right here. And if I align that with the sectors across the top, then I think that it makes sense to put the model sort of right here, moving from a market bottom into a bull market. And obviously that's the big debate that's going on right now. Is the S&P 500 or the stock market in general, is it bottoming out and trying to find its way back up? Or is this just a revival and are we ready for a move further down? My take from the sector rotation model, combining the readings from these macroeconomic indicators together with the readings from the rotation of the various sectors through these phases, I think we are positioned from a cyclical perspective somewhere between a full recession and an early recovery. And that puts the market itself, which is the orange line, between a market bottom and the beginning of a new bull market. Let's see how that looks on the chart of the S&P 500. So here's the weekly chart of the S&P 500, of SPY in this case. And what we see is that decline that marked 2022 in line with what we had last year in the sector rotation model. And if I look at the chart here, then I still see a series of higher highs and higher lows. I gotta admit that this dip here went a little bit lower than I had expected. If you look at a trend like this, you kind of expect it to, when you draw that imaginary trend line, I don't like to draw that trend line because it got only 2 touch points, and once again it's proven that has no value. But you sort of want to see that low come in right here, that old resistance. You want to see it act as support. You want to see that trend building. That didn't happen. But what also did not happen was that we broke that previous low. So the series of higher lows is still intact. The speed, the pace of that move has slowed down a little bit, but it's definitely still there. And out of that recent low, we're now pushing higher, and we're again in that 415, 416 area. And that is marked by the gap that was formed here in August 2022. And then we touched that again in January, at the end of January. And then we touched it again last week. And this is obviously, it's only 1 day of trading. But, we're challenging that 415, 416 range. And if we can take that out, then the next target is 426. But when that happens, we've already taken out the previous high here, which kind of confirms that uptrend on the weekly chart. Now, if I look at the RSI, that's neutral. That is, hovering, meandering around that 50 level. So it's not overbought, it's not oversold, there's no divergence here, which means that the S&P is not restricted in terms of the RSI. What I do like is the fact that the MACD, which has put in a pretty big positive divergence over second half of 2022 between the low here, which was in June, and the low here, which was in October, clearly 2 lower lows still in price, and you can see a higher low in the MACD. So that's the classic positive divergence. And it's still working its way higher out of that divergence. These divergences are a little bit longer than in the RSI. So that supports the turnaround for the S&P 500 and has just moved above 100, which is another positive sign. So from a weekly perspective, I think that we are seeing a turn out of that declining move out of the top of 470. And as soon as we take out 416, 417, and sequentially 426, the S&P is back into a move which could easily challenge the 470-50 area at the all-time high level. If we go to the daily chart of the S&P 500, obviously giving a little bit more granularity, we, no surprise, see the same type of picture, just a little bit more detail. Here is that downtrend line, and you can see how that even started to act as some form of support. But here you can see even more clearly how that 415, 470 area, the gap area here's the gap is on a day basis, and you can see that it actually tried to move back higher, didn't work that week, and then how that peak here that gap area with that peak started to act as resistance, and it's clearly still there. So out of that recent low, which was like one move on the weekly, you can see how that is a series of higher highs and higher lows on the daily, much more granular, and how that is running into resistance around 415, 417. But here also you can see a slight negative divergence building up between price and the RSI. So what that means is that we may need a little bit more time, and we're talking matter of days here, maybe this week, of either sideways movement or slightly down. And if all of this holds up, then I think that we should aim for holding above 405, 406 before we take out 415, 417 and then move higher. So if I bring all of that into context with the sector rotation model, which is suggesting that we are coming out of that market bottom into a new bull market, with outperformance for sectors like communication services, technology, consumer discretionary, materials, industrials, and a move out of the more defensive stuff, healthcare, utilities, staples, which are all on the right-hand side of that sector rotation model. I think that all in all, it starts to align more and more and more, kind of underscoring the move to a more positive outlook for the S&P 500 and the stock market as a whole. Before I'm going to spend the last 5 minutes of the show on a review of asset class rotation, I want to point out that the macroeconomic charts that I use in the sector rotation model, as well as the monthly charts that I use on every first Tuesday of the month, are available in a public chart list, and it's the code is 291885. If you look that up, I'll put the link in the description of the video. Then you get access to those 4 macroeconomic indicators and the monthly charts with annotations for all 11 sectors. Let's take a look at the RRG for asset classes. And I've plotted here below, and the first thing that everybody immediately sees is the big outlier, which is Bitcoin, or crypto as an asset class for sure. You can see how that has massively outperformed VBINX and pretty much any other asset class on the grid here. I'm gonna tick this off just because to make the chart a little bit more readable. So I'm gonna fit it, and then we see the rotations as they're currently going on. We talked about the S&P 500, how it's positioned as well. And you can see how SPY is inside leading. It's rolling over a little bit, which indicates slight negative outlook, but that is, we looked at the S&P chart and you can see how it's running into resistance. That's causing that to roll over. And you see how corporate bonds and high yield are inside lagging. Government are inside improving, but they're only slightly picking up on the RS ratio scale. And I think that if you look at the charts of IEF, we're going to do that in a minute, and SPY, it's basically a matter of who's going to break first to get a real preference of stocks over bonds. Until that time, they're probably a tie. More interesting charts are to be found, or more crucial pivot points maybe, for the US dollar and for commodities. Let's quickly look at a few of these individual charts. So here's Bitcoin, and as you can see that it came out of that big base. Everybody's talking about 30,000, 30K for Bitcoin, and yes, that's a very important level, but I think that it's more of a range between 28.5 and 31.5. And if we can take that out, then Bitcoin frees up the way for more upside potential. But the super negativity for Bitcoin and crypto is definitely gone. And I think we should approach Bitcoin from a positive perspective. Higher highs, higher lows, taking out resistance frees up the way for more upside. If you look at the US dollar, it's different. I mean, it came down hard after a massive rally, and there is very important support, because this is also on the monthly chart, super important support between, let's say, 100 and 104. And we're stretching it right now. So the US dollar is really stretching it. We're peaking below it. If you look at euro dollar, it's peaking above that 110 level. Very, very crucial. If we hold here and the market moves up, then it's basically confirming this massive breakout. If we drop back, that would be a very negative sign, because then all the way is free back to 95. So keep an eye on the US dollar, because it's at a pretty crucial level, if you ask me, for the move that's going to last months, I think. Already spoke about IEF, so government bonds. Here is the 7 to 10 year segment on the yield curve, and you can see how it's struggling with that 100 level. We spoke about that a few times. Again, if it takes out 100, 101, we got a lot more upside potential for IAF and for bonds, which will push yields down, which should be, alternatively, be positive for stocks. We're not there yet. We looked at the chart of the S&P 500, that's also struggling. Whoever's gonna break first is going to get the better angle in the stock-bond ratio. And if you look at that right now, SPY against IEF, then you can see that it is still tied in a range, and we're moving to the upper boundary of that range. And as long as that move is intact, I'm going to have a slight preference for stocks over bonds at the moment. And then really quickly, the move that could end that big correction, we talked about commodities a lot, and you can see how it's now starting. We dipped at previous high, now support, taken out that trend line, so it looks as if the decline, the weakness that we saw in commodities is fading, and we're starting to pick up. So maybe it's time to start keeping a closer eye on commodities. This is going to take a few months, but I think that it's about time to start keeping a closer eye on commodities again. It looks as if all that weakness is now fading away. And that wraps up Sector Spotlight for this week. Thank you for watching. I hope you enjoyed the show. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern on StockCharts television. And of course, you can catch the replays and watch previous shows on the StockCharts YouTube channel or any of the on-demand channels. Next week, Sector Spotlight will be a rerun, as I'll be traveling to attend the CMTA Symposium in New York City. The week after that, I'll be presenting Sector Spotlight from the StockCharts studio in Redmond, Washington. So I'm looking forward to seeing you again in 2 weeks' time for a new episode of Sector Spotlight. Of course, at the same time, at the same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.